Good morning, everyone, and welcome to another Nedgroup Investments Insight. Today we have Ian Anderson from Bridge Fund Managers, CIO and Portfolio Manager of the Nedgroup Investments Property Fund. Thanks very much for joining us today, Ian.
Thank you very much, Rob. Good to be here.
So the market pullback has seen a particularly severe on the listed real estate securities around the world and in South Africa. So despite the contractual rental income that should support valuations, and in the past, has been some sort of a buffer on the falling markets around the world. But we've seen the SAPI index has underperformed most local sectors during the first quarter. It's experienced its worst quarterly return ever, falling by 48%. The ASISA sector average has fared marginally better, but still that's fallen 45%. And the Nedgroup Investments Property Fund has provided a modicum of consolation by shedding a little less than 42.5% down for the first quarter. Not much of a consolation there, really. So Ian, look, let's begin with the market. Why have property companies been the scoundrel of this market downturn, despite the relatively transparent prospective cash flows relative to other industries?
Yeah, Rob, I think you probably hit the nail on the head when you used the word transparent, and I think that's the one thing that has become a lot less so. There's a lot of uncertainty around the cash flows, certainly in the short term. There's been a lot of publicity around some of the large retail tenants in particular who don't want to pay rent while their stores are closed. This is an unprecedented time. We've never seen anything like this. And I think the market is concerned around the sort of quantum of cash flows and the predictability of those cash flows. And then compounding that is some of these more interesting funding structures that have been established over the last 4 or 5 years, as some of these larger businesses have gone offshore. They've used cross-currency interest rate swaps to swap South African debt for European debt. You still have a South African asset underpinning that debt, but importantly now, with the rand having blown out, the value of that cross-currency interest rate swap, or the margin on that cross-currency interest rate swap, has increased substantially, and there's a negative cash flow implication. So not only are these companies struggling to generate revenues, but they're now also having to make these large margin requirements on those cross-currency interest rate swaps. So it's a double whammy. And then there's also this debate around whether these companies are going to pay dividends. And it's one of the key benefits of owning a listed property security is not only do you anticipate long-term capital growth, but importantly, you also expect to get a regular cash flow in the form of a dividend. And there's some uncertainty around that as well.
And so you mentioned there the uncertainty over whether you will be receiving the dividends that we previously expected, and I guess this is following on from the conversation that the REIT industry is having with government and the tax authorities. Is that what you're referring to?
Correct. Yeah. I mean, again, it's coming down to this cash flow, the shortage of cash flows, or the uncertainty around these cash flows. And so the industry has asked for a 2-year moratorium on the 75% minimum of 75% paid to shareholders in the form of a dividend out of their distributable earnings. That's how they enjoy REIT status. One of the things that they need to do in order to remain as a REIT, any income that they retain, obviously they have to pay the tax rate on. So they also want a holiday on that, so a tax holiday. I mean, look, the 2 years is just way too long. I don't think these businesses need a 2-year holiday. I think they need something for about 2 or 3, maybe even 4 months. And to be honest, I think they've actually just got that on Friday afternoon. And I think there were some notes that went out over the weekend. The FSCA and the JSE have allowed companies with March year ends to delay the publication of their financial results by at least 2 months. And that's obviously because they can't complete audits. So the fact that these financials can now be delayed means that the dividends can also be delayed. So those companies that have these very tight short-term cash constraints, they will be able to manage the process even if they don't get the dispensation from government in terms of their REIT status and the distributable earnings, they are going to be able to defer for a couple of months at least the payment of these dividends. So I think from a fund perspective, the fund delivered exactly in line with its distribution that we were forecasting for the first quarter of 1.35 cents. We've started the second quarter by collecting our fair best dividend, which is one of the largest dividends we get. So that's in the bag. We actually get the cash into the portfolio today. It's about 12 or 13 million rand. But obviously, the next 2 or 3 months, it's a bit more difficult to gauge how much of the distribution that we would normally get in the second quarter we will get, because these companies can't release results and can't pay the dividends. We do think that we will make up a lot of the lost dividends in the second quarter, in the third and in the fourth quarters as well.
Well, so that was going to be my follow-up question, really, is, maybe some of these businesses won't be able to pay for a couple of months, but it's not like a lasting impact on their ability to pay rent. And there's that contract there. If they're occupying space, they'll be required to pay that rental income into the future.
Correct. I mean, in South Africa, we don't have the same dispensation that some other countries have, where the tenants are where the tenants could potentially not pay rents. I think this is the dilemma that our industry faces now. The large retail landlords like Pep4 and the Foschini Group are using almost like a statement or a clause that was made by Abraham Patel recently, that allowed them to manage the process from a landlord tenant perspective, and they saw this as an opportunity just to say, well, our stores are not open, therefore we don't have to pay rent. Contractually in South Africa, as long as you're occupying that space, if your product is in that space, you still have to pay rent. The fact that you can't open your doors is not relevant, and so that's where there is this conflict between the landlord and the tenant. I think what you'll find is and this is part of this negotiation that is ongoing, is that they will come to some sort of compromise as to exactly how much rent the tenants will pay, given the fact that they aren't actually generating any revenues. Obviously, there are a lot of tenants that are still generating significant revenues. The Woolies of this world, the ShopRites, Spars, Pick n Pays are continuing to trade, and we saw from their March numbers they're trading at historically high levels with very high margins. But obviously there is a chunk of non-essential retailers that are under a tremendous amount of pressure. And I also think it's for this reason that the lockdown in South Africa probably won't be extended all that much. And if we look at some of the valuations, both in the property sector as well as on the retailers, the apparel retailers, it's clear that the market is factoring in close to a 2-month lockdown period. I just don't think this economy can sustain that. I think we will open up pretty shortly after the lockdown ends, albeit that we're not going to return to the normal trading levels. I think people are still going to be reluctant to go to the store, go to the shopping center, and obviously that is going to have an impact. And so again, it'll be a negotiated settlement. I don't think these retailers are going to get away with paying no rent, but obviously they will have to pay less rent than they have been paying historically. But it shouldn't have a long-lasting impact on the distributions.
Is this the distribution holidays or payout holidays? Is that confined to just retail, or are there other sectors within the SAPI also? Do you think they'll also be seeking that?
Look, I think everybody will try to take advantage of it if you can. I'd be very surprised though if everybody decided to not pay any dividends. I think it's going to be done on a company by company basis. If you look at the businesses that we think are most impacted by this, most negatively impacted by this, obviously a company like Hyprop is right at the top of the list. Owner of shopping centres in South Africa and Eastern Europe. Most of those centres are closed and they're not operating at all. They've also have used cross-currency interest rate swaps extensively, so their cash flows are under pressure. It's for that reason that they've announced that they will not pay an interim dividend in the second quarter. We normally expect them to pay a dividend now. They will defer that and pay that interim dividend in October this year together with the final dividend. So even a business that we think is suffering more than most is still is still thinking about paying a full year dividend, but only doing it in October. So getting the interim and dividend and final dividend at the same time. On the other side of the coin is a business like Fairvest, which is obviously one of the largest holdings in the portfolio, where the bulk of their centres are dominated by the retailers that provide essential products. So they're anchored by a grocery, the big grocery anchor, and they tend to dominate. And so that business hasn't given any indication to us that they're going to reduce their dividend or that they're not going to pay a dividend. And in fact, we're receiving a dividend from them today. So I think it's, the industry is obviously looking to rescue as many of these REITs as possible. And so they have to go to the ones that are most at risk and say, well, how much time do you need? What do you need to do in order to get through this particular crisis? But I would, and we've done this exercise across the Nedgroup Investments Property Fund, and we think there are very few businesses in that portfolio today that are in that position. The two that we would highlight as being the most at risk, and we actually sold quite a bit of those positions just on a month ago, were Vakili and Redefine. Both of them have got significant shopping centre exposure. Obviously, Vakili has significant exposure to Spain, which is now becoming one of the two sort of epicenters for this virus. So Italy has gone through their worst, but Spain is only just now starting to peak. And so they've had an extended lockdown, and obviously it's put significant pressure onto Vakili's cash flows. And then they've also been using cross-currency interest rate swaps, although they've done it slightly differently. So we're not as concerned. But Redefine is certainly a business that we think is going to come under pressure. And you can see what's happened to the share prices of both Redefine and Hyprop. Those are the businesses that are most at risk. And just looking at the Nedgroup Investments Property Fund, the exposure we have to those, we don't have any exposure to Hyprop. We have less than 1% of the portfolio now in Redefine, and we have about 1.5% of the portfolio exposed to Vakili. So the exposure there is very, very low.
You mentioned Redefine, and that was a position you introduced recently. But what about the other big property stocks within the SAPI? If the government allows REITs to reduce or withhold dividends, would you think they would reduce by? Would it be like a complete moratorium on the dividends for the foreseeable future, or do you think they maybe cut it by 50%?
I would say once again, it's going to be done on a company by company basis. There are a lot of businesses here in South Africa that continue to trade as per normal. Obviously, maybe they're not getting all of the rent, and maybe there's going to be pressure on them to reduce rentals. But I think, by and large, if I look across our fund, the number of companies that are battling to collect rent is actually quite low. We got Spear, which is another big holding in the portfolio, recently gave an update to market, and they've already collected more than 60, and this was last week already on Wednesday or Thursday, that they'd already collected more than 60% of their rental for March. And it's normally, that's not too dissimilar to their normal levels. They usually, by the second day of the month, they've collected about 95% of the rent. So this was a day or two in, and they'd already collected 60% of their rent. So it is very much horses for courses. If you look at the bigger listed property companies, we think Growthpoint is certainly not going to cut the dividend substantially. They obviously do have some shopping center assets, and they are obviously also batting in that category, but they have other assets that are obviously still generating substantial rental income for them. Their balance sheet is obviously much stronger than some of the others. And so, the indication from Growthpoint at this stage is that they might reduce the payout that they pay, but they're certainly not going to eliminate their dividend altogether. I think most of these businesses know that would be almost suicide for them. The sort of shareholders in those businesses anticipate dividends. If you can pay that dividend, you pay it. Don't just take advantage of this moratorium because it gives you the opportunity to shore up your balance sheet. I think they're all competitors. They're all competing for a share of the capital that's made available to them. These businesses are very capital intensive businesses, and you want to have the lowest cost of capital. So even, so if you cut your dividend now, or you don't pay a dividend now, shareholders are going to remember that. And so I think most of the companies that can pay dividends will pay dividends, and we think GrowthPoint will be one of them. It's one of the reasons why we are looking at GrowthPoint right now to potentially add it to the portfolio. Obviously, the yield now is in excess of 20%, assuming they pay 100% of the dividend, which we don't think they will. But if they don't pay 100% of their dividends in 2020, they will pay 100% of their distributable earnings as a dividend in 2021. And I think that's another important thing. If you look at the distributions or the dividends this year, it's not the right year to be looking. You've got to say, okay, what will happen to these businesses by the time we get to 2021? And most of those companies will be paying pretty much close to 90 to 100% of their dividends. That's our assumption at this stage. But it's premised on the basis that we don't have a 2 or a 3 month lockdown period, that the economic activity globally starts to pick up towards the middle or the end of the third quarter, accelerates into the fourth quarter, and we actually have a strong start in 2021. And I don't think that's too dissimilar to what most economists are forecasting right now. But clearly at the moment, people are feeling very nervous, very apprehensive, because we're in this lockdown where a number of companies just aren't trading. But we would still anticipate receiving probably somewhere between 65 and 75% of the dividends that we've been forecasting for this year, although we might get them later on in the year as opposed to now, simply because the companies won't be declaring dividends as they have to delay the reporting of their financial results in the second and third quarters.
So let's say the lockdown period is extended and for an unforeseeable amount of time. Is there a direct relationship between how the problems within the sector exacerbate over time and the fortunes and the dividends, obviously, and then equally then the knock-on onto market prices? Or do you think they've fallen far enough already? Is it already reflecting in the market prices?
Yeah, I mean, as I said, I think earlier I mentioned that, if you look, certainly some of the research that we've been reading around the valuations of some of the other sectors that are in lockdown, like the apparel retailers, the market seems to be anticipating a 2-month lockdown. So, at the moment we're on a 3 month, so that would be another 3 weeks. So that would be another 5 weeks of lockdown. And I think that same trend has filtered through into the listed property sector. I mean, if you just look at two of the hardest hit large cap businesses, Hyprop and Redefine, they are actually now priced pretty much for bankruptcy. And the forward yields or the historic yields on those businesses are upwards of 40-50%. Now that would only be appropriate if you didn't think that these businesses were going to survive, or if you thought that when they came out of this lockdown period or out of this economic slump, that 30 or 40% of their rental income would have been wiped out. Now, yes, if we have a 3 or 4 or 5 month shutdown, that probably is the case. A lot of the businesses that are tenants in those portfolios will actually not survive. And I think it's also for that reason that I do believe globally we just can't keep this lockdown going for much longer, because eventually you're just going to put more and more businesses under, more and more households will suffer. There's no income coming into a lot of households. We just happen to be in an industry that can continue to operate, but there are a lot of industries away from financial services and sort of essential services that aren't working, aren't operating, aren't generating any cash flows. And at some point, the government's going to have to, and governments globally are going to have to take a stance and say, well, we think we've got this pandemic under control. We now have to open up the economies. As I said earlier, also, I don't think everybody's going to rush in and start consuming products in shopping centers, but there should be a pickup in activity. These companies will then start to pay rental. And I would say that and we've looked at this here in South Africa, we've looked at it in Australia, I would say that for most of the retail landlords, they will go back to levels of around 80 to 85% of the rental that they were receiving previously. So there will be some tenants that don't make it. There will be other tenants that will need to be nursed through maybe another 12 to 24 month period. And then obviously there'll be a big chunk of tenants though that have been unaffected. And those are your large grocery anchors, sort of dominant in many of these malls. So if you then make the assumption that, let's say by the third quarter or the end of the third quarter this year, a REIT like Hyprop or Redefine is collecting 80% of their rental, well then the share price, in my opinion, has to go up by 2, 3, or 4 times. I mean, that's the sort of value that we see, because the market is definitely not pricing for that. The market is saying at best they're going to have maybe 40 or 50% of their rental income by the end of the third quarter, and I just don't think that's a realistic assumption. I think they're going to have a lot more as long as the shutdown doesn't last too long.
So it sounds like you think there'll be a recovery quite a bit sooner than prices are like within the next 12 to 24 months, and that's more across the board, not just within the property sector.
Correct, absolutely. I mean, the one thing that we do know is that financial markets recover far quicker than economies. So the financial markets are forward-looking. If we can, as we assume now, getting to the worst of the pandemic, and I think the United States is probably starting to peak this week. Spain has probably just peaked, and those were the 2 worst affected countries. Well, they are the 2 worst affected countries right now. They are now peaking. We should start to see evidence of a slowdown in cases. We should start to see evidence of a slowdown in deaths, and then slowly but surely the economies will open. As soon as that happens, I believe already we will start to see asset prices re-rate substantially. You know, we've had a particular, and the listed property sector and the apparel retailers are probably the 2 sectors, and maybe our banks as well, are the sectors that are likely to benefit the most as economic activity resumes. You know, the banks are obviously lenders into the property sector. They're under pressure. Obviously, the apparel retailers are very large tenants for the listed property sector. So all of those 3 sectors are interlinked. And I think they've all suffered sort of anywhere from a 35 to 50% knock in terms of capital values. And I think that can be made up. Not all of it. I certainly don't think we're going to go back to the levels we were at, sort of 3-4 months ago. And those were still pretty depressed levels anyway. But we should certainly make up at least 60 to 70% of those losses over the next sort of, I'd even say probably within 6 months. But as long as this lockdown is removed, as long as the lockdown doesn't last for 3 months, I think we should see a very strong recovery in prices. And importantly, we then also should see a much lower impact on overall distributions from the fund, both in 2020 and 2021. So at this stage, our sort of our forecast for distribution growth, we still think that there'll be moderate distribution growth this year. Previously, we were expecting distributions to grow in excess of 20%, and that was just coming off the very low base we created last year. We think we can take that 20% out of the equation now. That's probably what these guys are not going to pay. We've already got all of the first quarter. We've started the second quarter very well. So that would then assume that from the rest of the second quarter, third quarter, and fourth quarter, we only collect about 65 to 75% of the distributions that we've been forecasting. And that should still give you flat distribution growth year on year. And importantly, that's still a yield well in excess of 20%.
Thanks, Ian. Just focusing on the fund and strategy a bit more. For the consistency of yield, you've been wary of big shopping centres, and you talked about that earlier in terms of Hyprop and Redefine. But so a lot of people are asking, why has the fund suffered a bit worse than competitors over the last 12 to 18? And I guess within your answer, can you address or discuss what's going on with Delta and Robosis at the moment, please?
Yeah, I think one of the big issues is that the fund has had a higher exposure to South African listed property companies. And over the last 18 months, as the situation in South Africa has deteriorated, as economic activity has slumped and just nothing really seems to get going. There is the policy reforms that were promised just never materialized, and so the exposure that the fund has to South African focused REITs like a Delta and a Rebosis, there's obviously been little or no appetite for those businesses, and investors have just sold those companies, in my opinion, indiscriminately. In the case of Rebosis, there was a good reason to. They'd obviously had that exposure to UK shopping centres, but they don't have that exposure anymore, and I think they're very lucky that they were able to offload that business. Yes, they did take a loss, but importantly, that business would be losing substantially more money right now. Clearly, from a Rebosis perspective, they do have a portfolio of shopping centres here in South Africa, and those centres are predominantly closed, just as they are for many others. But I think what the market doesn't appreciate is that they also have a very large office portfolio as well, which is pretty much fully let and mainly to government. On long leases, they have been able to now sign longer leases with government. In fact, they are signing up to 9-year leases. That Rebosis is, and similarly for Delta as well. They don't have any shopping centres, or they've got 1 or 2 small shopping centres in the portfolio, but the rents are predominantly from government, and now most of those, in fact all of those government leases have been renewed bar 2, and so the business is in far better shape. But clearly at the moment there is just no appetite for any property company in South Africa, and so these businesses continue to suffer. There are a couple of other companies that we can list, South African focused businesses, but we think that these companies, because they haven't gone offshore, because they haven't used cross-currency interest rate swaps to fund that offshore expansion, because their gearing levels are more appropriate for this sort of these sort of issues, that they are in better shape, and it's for that reason that we think, away from Delta and Rebosis. So those 2 companies we do think will take advantage of any opportunity to not pay dividends. But away from those, the other businesses that we own, we think that by and large they will continue to pay dividends. Spear, as I mentioned earlier, they're collecting the rental, they have maintained their guidance, they expect to pay a dividend. And 100% of their dividend. We've had 1 or 2 other companies also suggest to us that there's no reason why they shouldn't be paying all of their distributable earnings out as a dividend. So we're more confident about the businesses that we own than the businesses that we don't own. Some of those very larger companies. However, having said that, the sharp sell-off that we've seen has made a number of those larger companies a lot more attractive to us. And you should start to see more and more of those businesses in the portfolio.
And just on the government tenants, is there any risk that they might seek rental holidays as well, given the tax pressures?
I don't know. I mean, it's a very difficult question. The government continues to function. Obviously, we've already seen 2 ratings downgrades in the last 2 weeks. We had a Moody's downgrade to junk, and on Friday we had a Fitch downgrade to another, 1 level lower in junk, and also still with a negative watch. I think government now needs to show that they are doing all the right things. I think not paying rents is not going to be one of the things that they need to do. They've got to pay those rents. They've got to be seen to be capable of maintaining those rents through this particular period. I know there is talk of $1 billion loan from the BRICS Bank. I mean, that should all help shore up our finances. But yeah, I mean, it must. I mean, with any tenant today, I think, whether you are government, whether you're a large multinational, whether you're a large national, I think there's a risk that you are going to struggle to pay rent at some point. But I think at the moment, we would still see the government as the most creditworthy landlord, despite the fact, most creditworthy tenant, despite the fact that we've had these downgrades. We do anticipate that government will continue to pay their rent, and certainly that's what has been indicated to us by their landlords.
Okay, thank you. Just on prior to the coronavirus pickup, there was some corporate action being touted around the industry. Is that still moving forward, and or have you seen that tail off because of the uncertainty?
No, I think if anything, we're getting more inquiries now. I mean, this is a great opportunity for somebody with cash, a strong balance sheet to go in and buy some of these listed property companies at massive discounts to net asset value. So we certainly are still getting inquiries. I think there is uncertainty, and so for that reason, it's more just putting feelers out at this point. I think once the lockdown is removed, and we see economic activity pick up again, I think some of those potential buyers might become a lot more serious. But it is underpinning some of the share prices of the businesses we own. Certainly Safari is always in play, remains in play. It's definitely been the top performer in our portfolio since the pandemic started. I think it's almost flat over this period, which is not something you can say for most of the other companies, but that's just because there is this underpin to the share price because of the number of suitors looking to acquire that business.
Okay, thank you. And I'm just going to ask you to give some final thoughts now, and also perhaps within that, can you just touch on how you can be fairly confident about the distribution expectation given the removal of distribution guidance by the underlying company management?
Yeah, so I mean, I think just to start, I mean, obviously I've experienced a number of downturns in the listed property sector. I've been managing listed property portfolios since 1996, but I've never seen anything quite like this. And I think it's a combination of people are fearful about the economy, people are fearful about their own household incomes, and importantly, people are also fearful about their health. And so you've got all of this negativity being reflected today in share prices, and obviously creating what I believe is a very significant short-term, a very significant long-term opportunity for investors to acquire good quality South African and offshore property companies on historically low yields. We've never seen yields this low. This even surpasses what we saw in 1998. The bulk of these businesses will survive. I think that's the one thing that I will impress on people is, yes, there might be one or two casualties, and it's difficult to pinpoint who those might be. Companies with exposure to Europe, we don't know how long that will last. Companies with stretched balance sheets in South Africa, companies with stretched balance sheets in Europe. Some of those businesses won't survive, but the bulk of them will, and they will offer substantial upside for longer term investors. In terms of the distributions, as I've said, for this year, we've already got the first quarter in the bag. We've already started to collect our dividends in the second quarter, and at this stage, none of the companies that are paying in the second quarter have indicated they're going to do anything less than what we had originally forecast. The difficulty now, though, is what happens for the rest of the second quarter, the third quarter, and the fourth quarter. And as I mentioned, we think that we should still get between 65 and 75% of that income. There are a number of companies that are not suffering the sort of cash flow woes that a Hyprop or a Redefine or a Vukile are suffering right now. So the bulk of the businesses that we own, most of the tenants are still paying rent, most of the tenants are still occupying their space, and most of the tenants are still operating out of that space. We also think that the lockdown will be removed, maybe not immediately at the end of Thursday next week. It might be extended for another week or maybe two, but we think after that there will be significant pressure on government to remove the lockdown. Economic activity will start up again, rents will start to be paid. Most of these businesses will then be in a position to start paying dividends in the third and fourth quarter, and that is the indication that we've got from these companies. They might not be able to pay dividends now, but they do think that they'll be able to pay their dividends in the fourth quarter, and they'll make up any of the dividends that they didn't pay out now. They know how important those dividends are to their shareholders, and if they've got competitors who are paying dividends, then they're going to be forced or pushed to pay dividends as well. They are competitors. These businesses all compete against each other, and they compete for capital. That's it from us now. Thank you very much, Rob.
Thanks very much, Ian. Actually, something you said there made me think of one of the businesses you do own that should be slightly more robust is Equites, and I saw that was reduced to quite a small position in the fund. Have you been buying that back given the fall?
Not yet, but that is certainly one of the businesses that we will look at. I think it's important. There's been no sector that's really been spared. If you think about what Equites business is all about, it's about moving product around the country. It's about moving product from one country to another, and that's not happening right now. Their tenants are not operating right now, so they're certainly in far better shape than many of the other companies, because I think some of those warehouses are still operational, but unfortunately they are exposed to the global supply chain, and so no sector has been truly immune from this, although some have done slightly better than others. But yeah, Equitas at these levels is also definitely on our radar to add to.
So thanks very much for your time, Ian. I really appreciate it.
Thanks very much, Rob.
So in a difficult time for advisors and investors in the real estate sector, and also in the Nedgroup Investments Property Fund, we're acutely aware of how hard it is to remain confident that the prospects for the asset class are optimistic. However, if you sit back and you think about it, the properties held in the portfolio will continue to exist, and they will contain tenants that will generally pay their rental commitments into the future beyond the current environment. So hopefully a return to more normal conditions around the world should restore confidence. And even if we assume a significant haircut like we've been talking about today, it appears that prices in the sector have fallen way too far. So I hope you gained some confidence from listening to what Ian Anderson was saying today, that there is actually some extreme valuations here in the portfolio. A quick reminder that we also recorded a podcast with Ian during the recent fund manager workshop, so that's available on the Nedgroup Investments podcast channel. Please sign up to receive the podcast notifications. Please like our channel if you do. I hope you do. And then finally, a reminder that later this week, we have Resolution Capital taking us through their views on real estate around the world. We've got Jeremy Lang from our with an interesting take on the behavior aspects of what's going on in the market moves recently. But first up, though, I hope you would dial in again tomorrow, as Ray Wallace from Taquanta will be discussing movements in the local cash and money market instruments. So finally, thanks very much to everyone for joining today. I really appreciate it on this dreary Monday morning in Cape Town, but have a fantastic week and talk to you